street parking when there's tons of lots that are totally empty because they're so expensive, right? That's totally inefficient, right? The social cost of you parking in that lot is nothing, and yet you're not parking there, right? So those are a couple of examples, like more extreme examples of the distortion that comes from monopoly pricing. Okay. Effectively, monopoly means that consumers have an externality on the firm. If they consume one more unit of the good, the firm is going to gain some profits, right? But the consumers aren't taking that into account, right? The size of that externality is the markup of price over marginal cost. The extra profits created are not mediated through the price system. And so this obviously suggests a natural Pigouvian solution. So for example, you could subsidize the purchase of monopolized goods, right? Or you could force the firm to reduce its price down to cost, or mandate that they have a minimum quantity, right? So some of these are used in practice, as we'll talk about on Thursday, but they're much less common than you'd think. And in Lecture 13, we'll talk a little bit about why. But just keep in mind that there's lots of types of things, almost anything that will get people to consume more of a monopoly-produced good is good. So for example, when there's a lot of prestige associated with a product that's owned by a monopoly firm like Apple, that's actually a good thing because it's increasing the demand that people have and therefore reducing the monopoly distortion. Yeah, go ahead, Jacob.
So I don't understand how subsidizing consumers for purchasing the good would work if everyone's subsidized. Because wouldn't that just increase demand and you'll still have...
No, because if we increase demand, that moves up the marginal revenue curve, and that's going to increase the quantity that gets sold.
Also move up the optimal quantity?
It moves up the optimal quantity. Well, but that's fine because the subsidy, the subsidy is like a wedge, and you actually don't want people to. The optimal quantity doesn't move up because the optimal quantity is where the original demand curve intersected marginal cost, not where the shifted up marginal demand, not where the shifted up demand curve intersects marginal cost.
Why, if they're getting more utility, isn't that?
Well, because the government's paying for that utility. That's what the subsidy comes from.
In the case of prestige, like I understand how.
Well, in prestige, I mean, it depends how you interpret prestige. I mean, is that really giving people more enjoyment, or is that really just some figment that's in people's minds? And you might think a lot of advertisement is sort of like that. Like advertising might sort of artificially increase people's demand for a good, but that's actually a good thing if the good is monopolized, right? Because that offsets the monopoly distortion. Yeah, go ahead.
If there was like a subsidy for people who bought the good, couldn't the company then just raise the prices by the amount of the subsidy?
Well, no, that's what I was saying. I was saying they're not going to want to raise it by the full amount of the subsidy, right? Because their marginal revenue curve is going to move up, right? And so they're going to want to charge, I mean, their price may well move up, but in fact, there's some cases when their price could come down. Because if now they're appealing to more elastic consumers, then that's going to lead them to lower their price. But they're never going to want to increase the price by the full amount of the subsidy. We'll talk about that in just a second. Okay. So like any tax or externality, the social cost of reducing the quantity is equal to the markup that the firm has times the change in quantity, right? So because it's that wedge between price and marginal cost. Okay. So as a result, we can measure the deadweight loss from monopoly using the standard deadweight loss triangle that we do, right? The only real difference is that the size of the deadweight loss triangle is determined by the monopoly's optimum. And so that means that it is a particular size in relationship to monopoly profits, and we're going to explore that in a minute. So it's the triangle that's bounded by supply, demand, and the equilibrium quantity. Monopoly profits can be represented graphically in two ways. They are either the area between the equilibrium price and the marginal cost curve, or the area between the marginal revenue curve and the marginal cost curve, which is what we were talking about a minute ago. Consumer surplus can also be measured in two ways. It's either the area between demand and price, as we usually do, but it can also be the area between the demand curve and the marginal revenue curve up to the quantity. Because as the demand expands, as the quantity expands, the marginal revenue is what the firm gets, and whatever else is there is what's left over to the consumers. Okay. So this graph shows you an example of this. If the firm is producing here, its profits are either the area between price and the marginal cost, which I've graphed as this yellow thing, or the area between marginal revenue and marginal cost here. Consumer surplus is either this triangle up here or the area between demand and marginal revenue, which is this here. So why does that work out? Well, A and D are the same triangle, right? And so you can count it either way that you want. Okay. So there's a very nice quote from Alfred Marshall. That's the epigraph of the paper that you were supposed to read for this lecture, which says that, pretty much everything comes down to some question about incidence. So as you guys probably learned last term, you probably did these things where there was a tax imposed and you looked at how it was split. And then you applied that principle to think about all sorts of other shifts, like shifts in supply and so forth, right? Everything could, in the end, sort of be brought down to thinking about incidence. And the reason is, and this is what Marshall points out, that sort of most of economics is about, if I do one thing here, how does that affect everybody else in the economy, right? And the incidence of a tax, who ends up paying a tax, is sort of like a canonical example of exactly that analysis. Okay, so I want to briefly recap what you guys learned last term about incidence in a competitive industry. And then I want to contrast that to monopoly, so you guys are sort of tuned to what are the key things that differ when you think about monopoly compared to perfect competition. Okay. So does anyone want to try to articulate what are some of the principles of incidence under perfect competition? Kevin, do you have an idea?
Is that like something to do with the envelope theorem or something at all?
It's related. Yeah. Who bears the tax? What do we know about that in a perfectly competitive market? How about Ryan?
Well, in a perfectly competitive market, it doesn't matter who the tax is put on.
Yeah.
The producer and the consumer will get the same amount of tax regardless of the tax.
Yeah.
Elasticity.
And it depends on the elasticities of demand. Yeah, that's absolutely right. So the first thing is what exactly Ryan said. It doesn't matter who physically pays the tax. All that matters is the elasticities, right? And in particular, what matters is the pass-through rate. That is, if I put a tax on the firm, how much of that ends up being absorbed by consumers, right? Now, Matt, that gets... Well, actually, let's wait 1 second. I'll get back to your question in just 1 second. OK. So the second principle is the split of taxes between consumers and producers is determined by the pass-through rate. What's the pass-through rate? How much the price to consumers increases when a tax on the firm increases. And because it doesn't matter whether the tax is charged to consumers or producers, we can just by default assume that it's charged all to the producers, right? So the consumers end up paying how much the price increases to them. The producers pay all of the rest, because that's how much the post-tax price falls to them, right? And so consumer welfare falls by the pass-through rate times the quantity. The producer's welfare falls by 1 minus the pass-through rate times the quantity. And then the government gets as revenue the quantity, right? OK. This is called the envelope theorem, because basically we can take as given that the consumers are choosing the quantity that maximizes their welfare. And so we can hold fixed the quantity that they're consuming as we increase the price that they're paying. And that's got to reduce their welfare by the amount that the price increases times the quantity that they're consuming. OK, so the incidence of a tax is the ratio of how much is paid by the consumers to how much is paid by the producers. So here that's pass-through over 1 minus the pass-through rate. right? Okay. The third principle is that the pass-through is determined by the relative elasticities of demand, which Ryan was saying. And in particular, whichever side of the market is inelastic is going to have to pay the tax. So if the elasticity of demand is high, this is going to be close to 0, right? And then the incidence is going to be 0, right? Consumers are going to pay nothing relative to the producers. If the elasticity of demand is low and the elasticity of supply is high, right, this is going to be close to 1. And the producers are going to pay almost nothing, and the consumers will bear all the tax, right? OK, so Matt Klein, or Matt, no, I'm going to call him King Solomon. How can you derive this formula? Market equilibrium requires, right, that demand, which is a function of price, is equal to supply, which is a function of price minus the tax, right? So how from that can you derive this formula? Anyone else want to try? Doing it on the board, maybe? Well, so demand, which is a function of price, is equal to supply, which is a function of price, minus the tax. So we can use implicit differentiation, right? So we can say, we know that the pass-through is how much the price changes when the tax changes. So d prime times the pass-through rate is equal to supply prime times the pass-through rate minus 1, right? And so, and of course, we can multiply and divide both sides by the price times the quantity to turn this into an elasticity, right? And then rearranging, we get exactly this formula. Because you get elasticity of supply divided by elasticity of demand plus elasticity of supply divided by elasticity of supply, and you get the elasticity of demand over the elasticity of supply. OK. So just to give you an intuitive sense for this, imagine that we have perfectly inelastic demand curve. Then when we have a tax imposed, the consumer pays the full tax, right? On the other hand, if we have a perfectly elastic demand curve and the supply increases, then the producer pays all the tax, right? Consumer prices doesn't rise at all. And in a more general case, it depends on the relative elasticity of these curves, right? OK. Now, one thing to notice is, imagine I just keep piling on taxes onto a market, right? Just keep raising the tax higher and higher. At some point, no one's going to be buying any products in that market, right? If you were to tax drugs a huge, huge, huge amount, that would be basically the same as making them illegal. Because people would just go to the black market or no one would buy it, right? So we can work backwards to figure out how much total consumer surplus there is, right? Because we know that the change in consumer surplus when we change the taxes is given by that incidence formula, right? And so we can start at the point where there's no market, and we can integrate back lowering the taxes. Because, of course, lowering the taxes has the opposite effect of raising them to figure out how much consumer surplus there is, right? So as we do that, the amount by every time we lower the tax consumer surplus increases is the pass-through rate times the quantity. The amount by which producer surplus increases is 1 minus the pass-through rate times the quantity, right? And so if we define the average pass-through rate to be the quantity-weighted average of the pass-through rate between